Hello, tradeologists. Well, we left off part one with talking about covered stock, and that is the purchase of stock with a put option for insurance in case the stock doesn't go in the direction that you had thought it would go in, which was up. Now, let me explain to you that it doesn't matter whether or not the stock goes up or down. But you know what? We try to avoid the hassle of it going down. We'd rather have the stock go up. Yes, the insurance is a cost, and it does cost us money to put on that insurance, but it's well worth the cost. I think you would agree. If you're buying 1,000 shares, even if you're only buying 100 shares, that one put option on your position does let you sleep at night. I mean, it gives you some comfort in knowing that if the stock does decline in price, or open up dramatically lower the very next day after you bought it, and it's happened before, it's happened to me, you won't lose a lot of money. I mean, I put a cap on the amount of money that I want to lose on initiating the position, and then at that point, either I cash in my insurance policy to buy more shares, or what I do is if the stock goes up, obviously I'm in a happy situation, and I roll those puts up as the stock increases in price so that I'm protected at higher levels. Now, I may not set it as close. I may not set that put as close. You know, if I bought the stock at $18 and I put an $18 put on there at the strike price of $18, you know, if it rolls up to $19 or $20, I might only roll that put up to the $19 level instead of the $20 level because I have a built-in profit at that point. So I'm always rolling up my puts underneath the stock price so that I have that additional protection as the stock increases in price. At some point, that stock may decline again, and I certainly want to be able to use that put as insurance to, cash in to buy some additional stock at that point and continue with the trade. So that's the real benefit. Now, here's a good question. What happens if the stock doesn't do anything at all? Let's say you purchased it here at $17.50. Let's go back to our Starbucks chart again. You purchase the stock at $17.50, and it just kind of meanders, and it doesn't really do anything. And all of a sudden, you're, about a month later, you're still at $17.50. Well, I don't particularly like. I'll pay 1 month of insurance on a stock, and you know what? If it doesn't pay off or the stock doesn't move, then I don't really want to hold that stock anymore. I will go into something that's a little bit more active. So I will only hold a position like this. Let's say I bought this at $18 now and I put an $18 put on as insurance. I'll hold that for a month. If I have to go back in and the stock has not moved and it's still at $18 and I have my $18 put, it's going to expire worthless. At that point, I'm going to call it a day and say, hey, you know what, the stock isn't going to move. Unless something happens in the stock beforehand, if I think it's about to make a dramatic move upward, I may stay with the stock a little bit longer, but generally I'll give it a month to move it. If it doesn't move either up or down, then I want to look for other opportunities, free up my capital, and put it into something a little bit more opportunistic, a little bit more potential. Also, there are other strategies that you could take advantage of. For example, one of the strategies in Starbucks that some people really prefer is, let's say, because June only has seven days left, we're going to go out to July here in this time frame. Let's say you wanted to buy Starbucks. You really wanted to hold it for kind of the long term. You didn't know whether or not it was going to go up immediately in price or not. Well, one of the things that you can do in order to pay for your put option, let's say you buy the stock at $18.40 where it is today, and you purchase one of the 17.5 strike put options. Well, in order to help defray the cost of that put option, you can also sell a call against it. So very similar to a covered call strategy in which you buy the stock and then you sell a call at a strike price just higher than the current price of the stock. So if the stock is at $18 and you sell a call option at $19, that's called a covered call strategy. Let's just go ahead and do this. Let's do a... let's see, do they have that in here? They have covered stock. They have a collar with stock. Let's go into... I don't even know if they have that in here because it's frankly, it's not a very good strategy. Someone else had asked me in the course about it. It's not a particularly attractive strategy. Let me show you why. If I go in here and I go ahead and buy the stock, let's say buy 500 shares, and then I'm going to go ahead and sell these, which would be considered a covered call here. We're going to do 5 on 5, 500 shares of stock and sell 5 of the 19 calls. Let's go ahead and analyze this. I've got some other things in here. Let me take that out first. Let's go ahead and analyze this, and I'll show you why this is not a particularly attractive strategy. What the covered call writer is hoping to do is to capture the premium of the premium here on the 19 strike price call. You'd be able to, on 5 shares, you'd be able to capture about $200 or so in premium on that if the stock does not move. If the stock moves up to $19, which is your strike price on your call, well, you're going to make a few $100s. You'll probably, if at $20, you'll make about $400, which is pretty much the cap. Well, maybe even $600 at the most. But the problem with that kind of strategy is that you have no downside protection whatsoever. You can see that the downside to the stock is basically, unlimited. If the stock continues to go down, you have an unlimited loss on the downside. That's why I do not suggest a covered call strategy. Covered call strategy is basically the same. It's the same as just a regular old call. So let's say we go into Starbucks again and we decided to buy this call here. Let's delete that out. Let's just buy that as a call and analyze that. You can see basically that there's you have downside limited risk and you have upside potential, but if you sold that call, you'd have basically a mirror of what you just saw with a covered call strategy. You have limited upside profit potential, but unlimited downside risk if the stock continued to go up. The exact same chart that we just saw would happen if you sold a put against that. Let's get rid of that call then. You'd have basically the identical graph, which is a limited upside potential profit and an unlimited downside risk. So, the covered call strategy. Let me just show you that again because I wasn't able to put both of those up at the same time. We purchase the stock, and at the same time we sell the calls against it. In this case, we're doing 5 calls sold against 500 shares of stock. And you can see, there's limited upside potential and unlimited downside risk to that position, which was opposite of what we did when we sold the call. But if we sold a put, you basically get the exact same graph. I'll take these two out. That's the graph of a naked short put. And so the naked short put and a covered call strategy have the exact same profit and loss graph. In other words, when you do a covered call strategy, it is equal to selling, and we'll do the same number of shares, selling a naked put. And selling naked puts can be very dangerous, especially if you're in a down market. You can get killed. You can really get killed. You can have unlimited losses on that put. You can see there's very limited upside potential, very limited profit potential if the stock should move up, and there's unlimited losses on the downside if the stock goes down. So that's why I don't recommend covered call strategies. It's the same thing as selling a naked put, which is a very dangerous technique to use. So, what we're trying to do instead is limit our downside risk. And let me show you that graph again because, it is helpful to look at pictures. It kind of helps to, determine what you're doing.